The Hyliion stock has been the topic of many conversations lately, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is very volatile at the moment, we should always be mindful about which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Hyliion has been on a downward slide ever since its peak many months ago, and so far the market hasn't deemed necessary for that reality to necessarily change. Hyliion has to prove to the market that its products, even though interesting on paper, since I was clearly intrigued by them for the long-haul trucks, they also have to convince the logistic professionals that they can provide real savings on fuel expense, which is arguably one of the largest expenditure to incur. With the current oil price, it's not surprising that there can be many people looking to change the way they carry out their work. Meanwhile, the market is still in a very delicate situation. The capital is now more risk-averse than ever, with the VIX number making new highs in almost a decade, and a significant increase of interest rates in most economies around the world. There's little reason to risk losing money when there are more predictable, cash flow positive, and stable options. Despite all this, let's keep in mind that Hyliion is one of the very few EV startups that hasn't been involved in a massive scandal among those who began trading in the heydays of 2020. Developing new products is going to take some time, and the tolerance of the market really depends on the flavor of the moment. Nevertheless, it's clear to see that the downward speed for Hyliion has slowed down significantly, almost as if a floor has been found. This floor, of course, is still moving as we speak, but the speed at which it does so is so slow that we can safely say that there's increasing hesitance in going further down. Now, let's also take a look at the technicals of Hyliion. The trading volume of Hyliion has recently been 2.3 million shares, versus an average volume of 1.7 million shares. Over the previous 52-week period, its price fluctuated between $2.69 and $12.75. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of the company, and when we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through the current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal may happen sometime soon. The market cap for Hyliion is currently around $620 million versus an enterprise value of $416 million. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off all the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies is the intangibles, which means that they're not physical items or equipments that a company can use, but they're promises that this company can grow significantly in the future, such as pledges for major contracts, blueprints for new products, and the existence of charismatic leaders and managers. For startups, most of their valuations has been based on the intangibles, which can be valued in more favorable market conditions. In concrete terms, what this means is that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that a company is trading at a discount. It's only trading below its current book value, but it doesn't mean that the company itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place and it has been deflated back to normal ever since. As we compare the current price to the historical price fluctuations, the stock is 27% higher than the 1-month low, 38% higher than the 12-week low, and 38% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 120% versus a historical volatility of 80%. The put-call volume ratio is currently at 0.11. It's normal for many stocks to tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 115,000 contracts a day versus the 30-day average of 514,000. In terms of open interest, the most recent volume of open interest has been 65,000 contracts versus the 30-day average of 64,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying a contract would give you the right, and selling the contract would give you premiums with obligation to execute the contract if the counterparty chooses to do so. It's often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, then there may be a possible uptrend on the move, or that a reversal may happen if there's a lot of call options. The reasoning behind that theory is quite simple, and that is that most of options contract would expire worthless. In terms of shareholder structure, institutional shareholders own 30% of the outstanding shares. The biggest shareholders include Vanguard, iShares, and Renaissance Technologies. It's relevant to understand the shareholder composition of a company because this can help us to determine if the stock should be held long-term or to be traded short-term. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be between at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a trade. There's obviously a lot of exceptions to this rule, since many great companies are also held by retail and not institutional investors. But that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there is significant short interest in the total volume, this may be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 12% of the total float and 55% of them come out from the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short interest coming out from the dark pools, this may suggest that there are institutional positions taken to short the stock and there would be potentials for a short squeeze. My recommendation for Hyliion is to keep an eye on the company and remember to check for confirmations that the stock is no longer willing to go lower for the short or medium term. A dollar cost averaging approach would then be recommended for the next 6 to 12 months. I would recommend to commit in total 1 to 3% of the capital of your portfolio and would also recommend to split the allocation in batches of 10 to 20% at a time so that you may purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.